Um, you know that specific kind of low-level dread? Like
Okay.
the one you get when you check the news, you see the inflation numbers ticking up, and then you tab over to your 401k, and it just it feels fragile.
Yeah, the paper asset panic. It's a very real phenomenon, actually.
Exactly. It's that sudden realization that your entire financial future is basically just, you know, digital numbers on a server somewhere, bouncing around based on what the Fed decides to do on a random Tuesday.
Right.
And it makes you want to find something solid, something real.
Which is usually the exact moment when people start Googling how to buy gold or how to buy silver. We see it in the search trends every single time the market gets shaky.
Right. And that rabbit hole leads to some very confusing and honestly, sometimes sketchy places. But today we are skipping the YouTube conspiracy theorists.
Thankfully.
Yeah, and the late night infomercials. We're going straight to the institutional side of things today. We are talking about the Silver IRA.
Which is a legitimate government-regulated vehicle, despite how mysterious it often sounds to people.
It does feel a little esoteric, doesn't it? I mean, the idea of a Silver IRA sounds like something a pirate would set up for retirement.
Uh-huh. Yeah, a treasure chest IRA.
Exactly. So to make sense of this, we aren't just winning it today. We are walking through a deep dive analysis by Doug Young.
And this is key context before we really jump in. Doug Young isn't a coin salesman. He is a financial markets researcher. He's got over 20 years in the game, and he's a former financial director.
Right. And since 2011, he has conducted over 80, and I mean literally 80, evaluations of gold and silver IRA companies.
So he has seen the good, the bad, and the absolute scams. He's looked at the fee structures, the customer service, all the fine print.
Exactly. So our mission today for you listening is simple. We want to figure out if a silver IRA is the hidden gem that saves your retirement from inflation, or if it's a fee-heavy trap that's just going to cause you more headaches than it's worth.
We are going to look at the logistics, the costs, which are tricky, by the way, and the hard risks.
It's about moving past the shiny appeal of the metal and looking at the cold, hard math. So let's start at ground zero. What actually is a silver IRA? Because I think a lot of people assume it's just, buying silver coins with your retirement money.
It is,
Yeah.
effectively, but the mechanism is very specific. It's a self-directed IRA.
Okay, explain that distinction for us.
Sure, so most people have a standard IRA or a 401k through work. In those accounts, you're usually limited to a specific menu of paper assets, so stocks, bonds, mutual funds.
Right.
The custodian, like the bank or the brokerage holding the account, they make the decisions easy for you. They give you a list, you pick a fund, and you're done.
Right. It's very set it and forget it.
Exactly. A self-directed IRA is different. It's a legal structure that allows you to hold alternative assets.
Like real estate, crypto, and in this case, physical precious metals.
Correct. But the key word there is physical. You aren't buying a silver mining stock. You aren't buying a silver ETF where you own a share of a pile of silver. You are buying actual bars and coins of silver.
Okay, stop right there. Because this is where the mattress myth comes in, and I need to clear this up immediately. If I open a silver IRA, does a delivery truck pull up to my house and dump a crate of silver bars on my porch for me to bury in the backyard?
Absolutely not. And I really cannot stress this enough. If anyone tells you that you can do that with an IRA, if a company says they will ship the IRA metals to your home, run.
Really?
Yes. That is a massive compliance violation.
So I can't touch it?
You cannot take personal possession. If you touch the metal, the IRS considers that a distribution. That means you owe income tax on the whole amount immediately, plus a 10% penalty if you're under 59.5. It completely destroys the tax advantage of the IRA.
Wow. Okay, that's a high-stakes rule. So where does the silver actually go?
It has to go to an IRS-approved depository. Think of it like a super secure insured fortress, like Fort Knox for private investors. You own the silver, you have the title to it, but it sits in a vault in Delaware or Texas or Utah.
So it's tangible, but it's also entirely out of reach.
Precisely. It is allocated to you, but it's stored on your behalf.
I want to push on that psychological aspect, though. Even if it's in a vault in Delaware and I can't swim in it like Scrooge McDuck, people still flock to this? Why? What is the itch that this actually scratches?
It's the counterparty risk argument. Think about it. When you own a stock, you are trusting the company to perform. You're trusting their accounting. When you own a bond, you're trusting the government to pay you back.
Right.
Those are intangible promises. They rely on another party fulfilling a contract.
And if the system breaks or the company goes bust, those promises break.
That's the fear. Silver is a commodity. It's an element on the periodic table. It has intrinsic value. Doesn't rely on a CEO or a board of directors to have value. It doesn't need a government to say it's worth something.
Yeah.
For a lot of people, especially when the digital world feels shaky, knowing there is a physical bar of metal with their name on it offers a peace of mind that a digital account balance just can't match.
So it feels real. But feelings don't pay the bills in retirement. Let's look at the financial arguments in Doug Young's research. Why do people actually pull the trigger on this? What is the upside?
The primary driver structurally is diversification. But it's not just the old don't put all your eggs in one basket advice. It's about the type of basket.
You've used the building analogy before.
Right. Think of your portfolio like a building. If every pillar is made of the exact same material, like equities and stocks, and an earthquake hits that specifically targets equities, the whole building collapses. You need pillars made of different materials that react differently to stress.
Okay.
Silver often behaves as an uncorrelated asset.
Meaning it doesn't dance to the same tune as the stock market.
Often it dances the opposite tune.
Yeah.
There's frequently an inverse relationship. When economic fear spikes, investors dump stocks, they panic sell. Where does that money go?
It has to go somewhere. It goes to safety.
Exactly. They flock to safe haven assets. Gold and silver are the classics. So in a scenario where your stock portfolio is bleeding red because of a market crash, your silver holdings might be spiking green. It acts as a counterbalance.
It's insurance. You hope you don't need it, but it cushions the blow if you do.
That's the theory. It creates a floor for your portfolio so you don't hit zero.
Then there's the big scary word, inflation. We have all felt the dollar buying less at the grocery store. I look at my receipt and I just shake my head sometimes. How does silver play into that?
This is the second major pillar in Young's analysis, the inflation hedge. You have to remember cash is a guaranteed losing investment.
Because it just sits there and loses purchasing power.
Every single year. If inflation is 3%, your cash is worth 3% less. Historically, silver acts as a store of value. When the dollar weakens, meaning it takes more dollars to buy a loaf of bread, it usually takes more dollars to buy an ounce of silver too.
So it preserves your purchasing power. $100 might buy less bread in 10 years, but an ounce of silver should ideally buy the same amount of bread.
Generally, yes. It's not tied to the performance of the currency. It's a hard asset with utility.
Now, we've talked about safety, hedging, insurance. That all sounds very defensive. It sounds almost like a bunker mentality. But looking at the report, Young mentions something that sounds a lot more aggressive: high return potential.
Yes. And this is where the safe haven narrative gets complicated. Because while people buy silver for safety, the asset itself is not safe in terms of stability. It's actually quite explosive.
Meaning the price jumps around.
A lot. Silver is significantly more volatile than gold. But for an investor with a high-risk tolerance, that volatility is actually an opportunity. If you time it right, buying when sentiment is low and selling during a panic, the percentage gains in silver can vastly outperform the stock market.
So it's not just about protecting what you have. For some, it's a speculative play to grow the pot.
It can be. But that brings us directly to the risks. And honestly, this is the part of the deep dive where we need to be really clear, because the marketing for these IRAs often glosses over this entirely.
Right.
They show you the shiny coin, but they don't show you the chart where the price drops 30%.
Let's call this section the reality check then. Let's unpack the volatility first. You said it's more volatile than gold. Why? Why does silver jump around so much?
Two main reasons. First, the market is simply smaller. It takes less money to move the global price of silver than it does to move gold. But the bigger factor, and the one people usually forget, is industrial demand.
Oh, right, because gold is mostly jewelry and bars sitting in vaults. It's pretty. But silver is actually useful.
Silver is an industrial metal. It has the highest electrical conductivity of any element. It is in everything. Solar panels, EV batteries, medical devices, 5G towers, the switches in your car.
So its price isn't just driven by fearful investors wanting a safety net. It's driven by manufacturing cycles.
Exactly. And that is a double-edged sword. If the economy is booming and we are building millions of solar panels, silver goes up. But if the tech sector slows down or if there's a recession in manufacturing, silver demand drops and the price can absolutely tank. It is sensitive to the actual economy in a way gold just isn't.
So if you are looking for a slow, steady climb like a government bond, silver is going to give you whiplash.
It's a roller coaster. You have to have the stomach for it. You might wake up and it's down 5% because a factory report out of China came in low.
Okay, volatility I can handle if the payoff is there. But there's another risk that I think catches people off guard. And this one hits the wallet directly, the zero income problem.
This is fundamental. If
Mm.
you own a blue chip stock, what do you get?
Dividends, usually quarterly.
Right. And if you own a bond, what do you get?
Interest payments.
Right. Those assets pay you to hold them. You can
Yeah.
reinvest that money and get compound growth. Silver pays you nothing. Zero. It sits in a vault. It is a non-income generating asset.
So the only way you make money is if the price of the metal goes up.
Correct. You are 100% reliant on price appreciation. But it's actually worse than that. It's not just that it pays you nothing. It costs you money to hold it.
The negative yield. We really need to talk about the fees. Because unlike a standard brokerage account where trades are basically free now, a Silver IRA has a lot of hands in the cookie jar.
Doug Young emphasizes this heavily. You have the vault. That space isn't free. You have to pay storage fees. You have to pay insurance. You have to pay the custodian to manage the paperwork.
And these are annual fees.
Right. Every single year. And you have to watch the structure very closely. Some charge a flat fee, say $250 a year, but some charge a percentage of the asset value.
Ouch. So if silver prices go up, your fees go up.
Exactly. If you have a large portfolio, a percentage fee can bleed you dry over 10 or 20 years.
Let's do the math on that really quick. If silver goes up 3% in a year, which sounds okay, but your fees are 1.5%.
You've barely beaten inflation. You're treading water. You start every year in the hole. The price has to rise just to cover your rent at the depository before you make a single dime of profit.
There's another cost hidden here too, isn't there? The spread. Young alludes to this. The price you see on the news, the spot price, that's not the price you actually pay when you buy, is it?
No, and this is where a lot of people get burned. The spot price is the raw market rate for a massive 1,000-ounce bar. But when you buy coins for your IRA, you pay the ask price, which includes a dealer premium.
The markup?
Right. It covers the minting, the distribution, and the dealer's profit. In physical metals, that markup can be high, sometimes 5%, 10%, even more depending on the specific type of coin.
So if I buy $10,000 worth of silver, the moment I sign the paper, it might only be worth $9,000 on the open market.
Exactly. You are instantly underwater. You have to wait for the spot price to rise just to break even on the markup. That is a huge friction cost that stocks just don't have.
That is something the brochures definitely put in the fine print. Okay, let's talk about getting out. The liquidity issue.
This is critical for retirees. With a stock, you click sell on your phone and the cash is settled in days. It takes seconds to execute.
And with physical silver.
It's a process.
Yeah.
It's physical. You have to instruct your custodian to sell. They have to contact a dealer. The dealer has to bid on the metal. Then they have to arrange the transfer.
It's definitely not instant.
It can take days, sometimes longer.
Yeah.
And here's the kicker. If you need emergency cash, say a medical bill pops up and silver happens to be in a dip, you are forced to sell at a loss. You don't have the luxury of waiting for the market to recover.
So a silver IRA is a terrible place for your emergency fund.
Terrible. Do not put money in there that you might need next month. It is not a checking account.
So putting all this together, the volatility, the fees, the lack of dividends, the difficulty of selling, it really begs the question, who on earth is this actually for? Doug Young has evaluated 80 companies. Who does he say is the ideal candidate?
The verdict is pretty stark. This is not for everyone. In fact, for many people, it's a bad idea.
Who should stead away? Let's just list them out.
If you have a low risk tolerance, if you check your account every day and panic when it drops, if you need steady income like dividends to pay your bills, or, importantly, if you are very close to retirement.
Why close to retirement? Usually they say reduce risk as you get older.
Right, but silver's volatile. You don't have a time horizon. If silver takes a 20% dive the year before you retire due to an industrial slowdown, you don't have 5 years to wait for it to bounce back. You lock in those losses.
Okay, so who should consider it?
The ideal candidate is someone who already has a solid foundation. They have the stocks, they have the cash reserves. They are looking for that extra layer of diversification.
They want the bunker insurance.
Right. They have a high risk tolerance, meaning they can handle the swings.
Yeah.
And crucially, they have a long time horizon, 10 years plus.
So they can ride out the industrial cycles?
Exactly. They can let the inflation hedging properties actually work over time.
Right.
It's a long game.
There's a rule of thumb regarding the amount, isn't there? We aren't telling people to cash out their entire 401k and go all in on silver.
Never. Doug Young is very firm on this. The small slice rule. A silver IRA should be a component of a diversified portfolio. We're talking 5 to 10%.
It's the seasoning, not the steak.
I love that analogy,
Yeah.
yes. If you go 50% or 100% into silver, you're gambling, not investing. You're exposing yourself to massive concentration risk. If the silver market tanks, you lose everything.
Okay, let's say someone listening to this is nodding their head. They fit the profile, they have the time, they have the stomach for it, and they want that 5% hedge against the dollar. They are ready to look into companies. What is the due diligence checklist? Because if you Google this, you get bombarded with ads.
You do, and a lot of them are, let's be polite and say aggressive. Doug Young provides a very specific list of what to check before you sign anything.
What's number one?
Costs. Transparency on costs.
Right.
You need to explicitly ask about the storage fees and the maintenance fees. Are they flat or scaled?
And look for those scaled fees that grow with your account.
Avoid them if you can. Flat fees are usually better for larger accounts. Also, ask about the spread. Ask them directly, what is the difference between the price I pay and the spot price? If they won't answer, or if they dance around it, hang up.
Good tip. Number two.
Reputation and tenure. This is an industry where trust is everything. You are handing some of your life savings to buy metal you will never see.
So you want a company that has been around longer than a few months.
Look for a proven track record. Young mentions evaluating over 80 companies. That tells you there are a lot of fly-by-night operations out there. Check the Better Business Bureau. Check independent reviews. See if they have complaints about high-pressure sales tactics.
What about the vault itself?
Crucial. Research the depository. Where is it? Who runs it? Is it a major name like Brinks or Delaware Depository? You want to know your retirement is sitting in a fortress, not a self-storage unit.
And then there's the IRS compliance. This seems like the area where a DIY approach could really get you in trouble.
It's a total minefield. There are strict rules on the fineness of the silver. It has to be 0.999 pure. If you buy the wrong coins, like certain collectibles or numismatics that the salespeople might push because they have higher margins, they might not be eligible for the IRA.
And if they aren't eligible?
The IRS disallows the transaction, and boom, taxes and penalties. You need a specialist who knows the tax code inside and out. Don't try to guess on this stuff.
Finally, understand the exit strategy.
Right. Ask the company about their buyback policy. When it comes time to sell, will they buy the metal back from you? At what price? You want a company that makes the exit as smooth as the entry. You don't want to be stuck with silver bars and no one to sell them to.
So zooming out, what's the final verdict here? It sounds like silver IRAs are a powerful tool, but a sharp one. You can cut yourself if you don't hold it right.
That is the perfect way to put it. It's a specialized tool for a specific job. The job is diversification and hedging against a crumbling dollar. But the cost of using that tool is high fees, liquidity drag, and volatility.
It's not a magic bullet. It's not a get-rich-quick scheme.
Far from it. It's a strategic defensive move for a sophisticated investor.
It brings up a really interesting philosophical point about safety for me.
It does. We are conditioned to think safe means stable. We think cash is safe because the number doesn't change.
But the value of that number changes.
Exactly. In the world of commodities, safe from inflation often means volatile in price. To protect your purchasing power, you have to be willing to endure the swings. You have to ask yourself, is the peace of mind of owning physical metal worth the stress of watching its price jump up and down?
That really is the trade-off. Peace of mind versus daily stress. A fascinating dilemma for anyone looking at their portfolio right now.
It is, and it's one only you can answer for yourself.
If you want to dig deeper into the numbers, Doug Young has a comparative market analysis of the top-performing precious metals IRA companies. It puts the data side by side so you aren't just guessing.
Definitely worth checking out. Do your homework. Read the fine print.
That is all the time we have for this deep dive. Thanks for listening, and until next time, keep asking the hard questions about where your money is actually living.